Today was a pretty interesting day that involved everything. And by everything, we mean we were up, we were down, and then we were up. And there's a little bit to digest here, even though it was a relatively quiet news day, if you want to just exclude the war, international fear-mongering that has been going on for such a long time now, that we've basically all just completely droned it out and given it no importance, as it probably should have, because it's not really affecting the markets or the economy directly, but other things are. And very important forces, if not the most important forces, appear to be driving the market. Let's look at the market earlier in the day. Up slightly, not doing anything too crazy, and then right as the market opens, or a little before the market opens, the dollar starts going up a lot. And that seems to drive a market pullback. And then at one point, the dollar stabilizes, and roughly an hour later, boom, market shoots up. Let's go back to the crack cocaine of the weakening dollar. And when you weaken the dollar, what does that mean? That means that everything priced in dollars is now stronger relative to the dollar. So the prices go up. That means stocks. Now, the Fed doesn't want that. The Fed doesn't want a weaker dollar. They're now all of a sudden talking about reserve currency status. Barkin even today said the US dollar's reserve currency status has to be continually earned. So what they want is dollar strength. And you know what leads to dollar strength? Higher yields. Exactly. Higher yields lead to dollar strength, because when you increase yields, you increase the price of dollars. And when you increase the price of dollars, the value of those dollars go up. This is clearly in the interest of the Fed when they want inflation to go down. They want a stronger dollar, not a weaker dollar. We've had a weaker dollar. We've had falling yields for quite a long time now. However, both appear to be reversing. Yes, I said both. If you look at yields, whoa, it's been a weird couple days. Very weird couple days for yields. We very quickly got above pre-CPI levels in yields. On the same day, we got above pre-PPI yields after initially falling on that cooler than expected data. And then we had weaker retail sales and yields just didn't even flinch. So I think this is a very, very crucial development. And I'm not looking at the last hour or so rally in the market as a sign of strength at all. I'm looking at it as like the car is running on fumes, because there's very little gas in the tank now if these forces move. If the dollar strengthens and yields move higher, which there's every indication to believe is going to be the case. I mean, look at the bank earnings. They're not dying. This is not, Hiroshima out here in the banking sector because of what happened with SVB. It's just not. So every indication that flight to safety trade that occurred in yields, that allowed the dollar to fall, that allowed yields to fall, is beginning to reverse. And we're seeing that resilience right in the face of cool data for the first time in a long time. A long time that we've seen cool data, higher yields. It just hasn't happened. That's not what's supposed to happen. But because, like we said, this is the record, as far as I'm aware, the Billy record observational dislocation between the market and the Fed funds dot plot and the Fed expectations. They're not saying they're moving the dot plot. They're actually saying quite the opposite. They're saying they were conservative on the dot plot, at least Barkin, at least Waller type people, which is a lot of people on the Fed, the majority, or at least the section above the mean is larger in the hawkish direction than the second or median. The cohort more hawkish than the median is 7 times larger than the cohort more dovish than the median. So a lot of types say they were conservative on their most recent dot plot projections, given the banking crisis situation. Now, inflation has continued to persist in quite a hot way, core inflation has not yet budged. It's my assumption that not at the May meeting, but I believe either the June or July meeting, whichever one's after May, the dot plot is going to be moved more hawkish. So we're in for a pullback, in my assumption, given that the forces that have made this rally occur are now being reversed, and the stocks that have most outperformed are actually quite weak today. I'm talking about the tech stocks. So I think everything's fine. I'm not looking into the last hour or two of trading as any sign of strength, okay? Stocks aren't supposed to move in that direction, in that way, on nothing. They're just not. They're just not. Okay, they got a whiff of, oh, maybe that was it in the dollar, maybe that was it in yields. It's the beginning of the reversal in the dollar and yields. Okay? That's my assumption, at least. We'll see what happens. So far, the facts and fundamentals are pointing that way. We're seeing higher yields on cooler data. That is breathtaking. That is definitely worthy of note. Don't think about one day or one day's performance too much. Allow it to play out. Allow your thesis to play out. So that's today's video. And until next time, peace out.